China moving down 2.3%, and much of the emerging market world under some pressure as the dollar continues to go higher, and the post-Fed announcement, which indicated that at least while rates are on hold for the foreseeable future, the extended period language is still intact. The foundation for economic conditions is much better, and that's giving the dollar reason to kind of move up into new levels. In fact, somewhere around 77, 70, 80-ish, you start to get into a place where this thing probably looks like it goes up into the 80, 80.5 level. In that range, you actually get back all the way back to where the Fed began cutting rates back in August of 2007. So we went from 5.25 down to a quarter, and that had effectively knocked the dollar down about 10%. But we're getting to a place where we've taken much, if not most of that back, probably 2.5 to 3% away from these levels, but something to watch. And despite the fact that emerging continues to trade pretty well, and commodities continue to trade pretty well, and I think that's really the story here as we start to determine where the dollar finds its apex. China last night down 2.3%. In fact, China's struggling over the last few days, even in the absence of the dollar per se, down about 5% off the highs over the last week. India down 11 bips, Malaysia down 11, South Korea big mover down almost 1%, and a huge move in the currency. So combined move of almost 270 bips into Eastern Europe. You've got Russia down 1.6% after a huge move yesterday. Czech, Poland, Hungary down about 80 bips. The big move, again, is currency-wise. It's a reaction to the dollar, and then it's a pronounced move by a number of countries where they're very happy to see their currency weaken up. So in Russia, every chance they get in the central bank to see the ruble weaken up is well received. The real in Brazil, as Brazil opens down about 1.1%, down 125 basis points, and that's a major move for the real. We continue to trade in this range up to around 180, and think that there's pretty good support for it. But looking across Mexico, Chile, Colombia, markets are flat to down 50 to 100 bips. But the currencies are what we're watching. Peso off 1.04%. And finally into South Africa, where, again, you've got the most volatile of the currencies. The rand 160 basis points weaker, with a market that's actually up about 40 bips. So, overall, it's still follow through from the Fed. It's still a little bit more of a macro trade. Looking into Europe, you had off the downgrade of Greece yesterday, you've had their CDS widen out another 25 to 30 basis points. You had a bad retail sales number in the UK. You have not a very good jobless claims number in the States. You've had a few comments out of the Bank of China about their lack of interest in continuing to fund the U.S. deficit. So there's a number of things that are somewhat cross current in terms of what they mean for the dollar, but in general, none of it's very good, and that's the trade we continue to follow. Watch commodities today because oil holds in very well, and I think you're actually seeing a place where we're putting in a bit of a bottom, and that's really where the opportunity comes. Trades in some of the oil names and trades in some of the gold names, to me, make a lot of sense going into the first part of next year.